Hello from me, Jackie Arendse, and welcome to my next video talking about the South African tax system and looking at provisional tax and now looking at the third provisional payment. So we've done a few videos now on the provisional tax system talking about, are you a provisional taxpayer? If you are, how to calculate your provisional taxes, the penalties that apply for provisional taxes, and now we're going to talk about the third provisional tax payment. So if you need any of that other information, please go back and find some of the other videos, and you can access all that info on those videos. But looking at the third provisional payment, so those of you who've seen all the videos so far will be familiar with this little graph here, talking about the timing of the provisional tax payments. We've got the first provisional 6 months into the year of assessment, the second by the last day of the year of assessment. So if you're an individual with a February year end, or even a company or a trust with a February year end, then these will be the dates for your first and second provisional payment. So the second provisional payment has to be made by the last day of the year of assessment. Okay, and we spoke about the penalties that kick in for late payment, underestimate, and so on. What is the role of the third provisional payment? And that's this optional top-up payment that happens. And in the case of an individual, we talk about a date of the 30th of September. Well, there's quite a misconception. I should just clarify right up front that making a third provisional payment is not going to help you as far as your penalties are concerned. So your late payment penalties, your underestimate penalty, that is not going to be resolved with a third provisional payment. But where the third provisional payment can assist is with saving on interest. All right. And so if we look at the role of this third provisional payment, we saw that these penalties apply to the first and second provisional returns. The third provisional payment, really, as I've said, it's a voluntary payment. You don't have to make it. There's no penalty for not making that third provisional payment. Any provisional taxpayer may make a third payment, and you use the normal provisional tax form, the IP6 form, to do that. Why would you make a third provisional payment? It's not going to help you with penalties that might have applied to your first and second provisionals, but it can help you with interest, and interest charged by SARS can add up to quite a lot of money. So when we talk about interest, and it's a little technical here, we talk about Section 89 Quat. That's Section 89 Quat of the Income Tax Act. There's interest that is charged under that particular provision on certain provisional taxpayers. And it kicks in from what we call the effective date. And so although the third provisional payment doesn't achieve any reduction in penalties, it can certainly assist in reducing any interest that you might end up paying to SARS. So if we look at this interest, 89 Quat interest, this is interest that becomes payable to SARS when there's an amount of tax still outstanding after what we call the effective date. And it's payable by provisional taxpayers who have taxable income of more than 50,000 Rand in the case of an individual or a trust, and 20,000 Rand for companies. Now those amounts look alarmingly low. They haven't been updated for many years, but it really just means that most of your provisional taxpayers are potentially liable for Section 89 Quat interest. If you're a company and you have taxable income of only 5,000 Rand, then yes, a company is a provisional taxpayer, but you wouldn't have to pay interest under Section 89 Quat. All right, so it's really just putting a threshold in terms of who's liable for this interest, but most provisional taxpayers obviously will be potentially liable for the interest under Section 89 Quat. Now we talk about interest payable on an amount of tax outstanding after the effective date. When we talk about tax there, it means tax as finally assessed. So what is your final tax liability as per your assessment? And that includes any penalties and interest that might be charged. So that can include things like your late payment penalties, your underestimate penalties that will come through when you finally get assessed, and any interest on late payment, because when you pay your provisional tax late, there's also interest that comes through there. So your tax is not just the tax, it's the tax with penalties and interest. So what is the actual tax liability that arises on assessment, which could be almost a year after the end of the year of assessment? So the interest that applies is going to be the interest on any tax outstanding after the effective date. And when we talk about the effective date, that, as I've indicated there, is defined. It means when your year of assessment is ending at the last day of February, it means 7 months after, so it'll be the end of September. And if you've got any other year end, if you're a company, you have maybe a June year end, a September year end, whatever the case might be, effective date is 6 months after year end. All right, so your effective date is then that either 6 or 7 month period after year end. So really what this provision is saying is that if you have any tax still outstanding that hasn't yet been settled to SARS after that effective date, then the 89 quat interest is going to apply. And so that's where that third provisional payment comes in, is to say by the effective date, you have up until that point to make any top-up payments, maybe one or more top-up payments that you want to make sure that your whole tax liability is settled by that date. If there's anything that is still outstanding at that point, then 89 quat interest is going to kick in. And that's really the function of your third provisional payment, is to then top up your tax payments to make sure that you don't pay the interest. Now, you might say, well, my cash flow is tight. What if I don't make this third provisional payment? Well, then you would end up paying this interest to SARS, and you pay the interest on assessment. They will assess you. They will charge the interest at their current rate from the 1st of March 2025. That rate is 11.25%. It's linked to the Reserve Bank repurchase rate. And so you would end up paying that interest to SARS. And just bear in mind, though, that if you do pay that interest to SARS, it's not treated as a normal business expense in terms of you can't claim it as a tax deduction. All right. So if we said your year end is the end of February, your effective date is 7 months after that, the interest would kick in on whatever tax is still outstanding after that effective date. Now, if you think about the timing of this, if you're an individual and you have a February year end, you would have to submit your tax return in the following January if you're a provisional taxpayer. And so you're only going to be assessed when you actually submit your final tax return for 2025, which could be almost 11 months after year end. That will raise a certain assessment and a certain tax liability. Now, let's say that tax liability comes out at 800,000 Rand. If you've only paid through your first, second, and third provisional tax payments 600,000 Rand, then what we're saying is that outstanding amount of 200,000 Rand will carry interest. In this case, from the 1st of October 2025 through until that assessment is raised. And if it's only raised in January 2026, the interest will run on that amount through until the date of the assessment. All right, so it's calculated at the prescribed rate, so that's based on the SARS interest rates, as I say, currently 11.25%. That's from the 1st of March 2025, on the balance of tax outstanding from the effective date through to the date of assessment. So that links to the example I gave. If there was 200,000 Rand tax, let's say your final tax assessment, 800,000, up to your effective date, let's say you're an individual, up to the end of September, following your year end, you've paid first, second, and third provisional tax payments amounting to 600,000 and employees tax as well, 600,000. So there's 200,000 Rand tax that you think, well, I'll settle that on assessment, but it's going to carry interest at 11.25% from the day after the effective date up until the date of the assessment. If we bring all of this together then, if we said your year end is the end of February, your effective date is 7 months after that, assume your final assessed tax liability is 180,000. Going back to the tax calculation that we did in the previous video, let's assume your first provisional you paid 4,388, second provisional you paid on time, let's assume at the end of February 3,835, and you paid PAYE of 120,000 for the year. So your credit amount is what you've paid by the effective date, 162,998. So you have a balance of tax basically at the effective date. The amount you haven't paid yet that you're going to pay on assessment, 17,002 Rand, and you'd pay interest on that from the day after the effective date, from the 1st of October 25 in this case, up until the date on which you are actually assessed, which might only be, of course, in January 2026, depending on when you submit your tax return. So that becomes an actual cost to you. That interest is not tax deductible, but you can avoid it by paying enough tax by your effective date to make sure that there's no outstanding tax balance. So when you calculate your third provisional payment, you're going to say, what is your actual taxable income for the year based on your final assessment and what you think it's going to be, minus, work out the tax on that. Take out any rebates you might be entitled to, your primary, secondary, tertiary rebates, medical credits, any 6-quart rebate for foreign taxes paid by the last day of the year of assessment. That's your normal tax payable for the year. Take off on any tax that you have already paid, PAYE, perhaps from any remuneration during the year, right up to the end of February. Any first or second provisional tax payments you might have made. And then, of course, what you need to add on, because that tax liability includes penalties and interest. Have a look at your statement of account to see whether you know about any penalties or interest that SARS might already have charged. But some of these penalties, like your underestimate penalty, are only going to come through when you finally get assessed, because only then does SARS know whether you've actually underpaid based on what amount you should have paid. All right, so you might not know at the time of your third provisional payment about all your penalties and interest. But whatever you do know about, bear in mind that's an additional tax liability. And so you would then make your third provisional payment based on the best estimate that you can at that stage, bearing in mind that your final assessment is only going to happen several months later, and that might then arise or give rise to interest being charged under Section 89 Quat. So your third provisional payment is a voluntary payment. It's a top-up payment. There's no penalties for not making the third provisional payment, but depending on your final assessment and the tax you've already paid, if you don't make a third provisional payment, you could end up with interest being payable to SARS. I hope this has been useful for you. Remember that all of these videos are just for information. They don't constitute tax advice. You should always consult with an expert, a registered tax practitioner who can help you with your tax affairs. And I hope this video has been useful. Please like it. Please subscribe so that you can be advised of future videos as and when they come out. And please tell your friends about these videos, which are intended to be short, to the point, and as simple as possible in order to just create a greater awareness of South African tax legislation. Thanks very much. See you next time. Bye.